when you deposit money in your bank? This is interactive.
What happens when you put money in the bank?
Yeah, what happens to it?
It earns interest.
Sometimes.
It gets the bank interest.
Yeah, it can earn the bank money. So what if Teresa here is a bank? She decides to start a bank. And she puts $100 in to start her bank. And Autumn decides to deposit $100 in her bank. So now Teresa has $200 in the bank. And Pastor Denise comes and she wants to borrow $50. So Teresa gives Pastor Denise $50 and Pastor Denise pays it back, but she has to pay interest because she used that money. So now Teresa has the $200 again, plus interest. And so that's just real simple how the bank works. Money comes in and then they loan it out to people and then people pay it back. It doesn't matter if it's a checking account or a savings account that you put the money in, as far as what the bank does with it.
As far as what the bank does with it? No.
Well, if the bank, if Autumn put that money in a checking account, would the bank want to loan it out right away to Pastor Denise? Probably not, because Autumn would most likely be writing checks on that account and taking the money out. So the bank probably wouldn't want to loan it out because then they wouldn't have the money to pay Autumn. But if Autumn puts the money in a savings account, then the bank can assume that she's going to leave it in there for a while so they could go ahead and loan it out. So it does make a difference to the bank which way you're doing it. So when you deposit money in the bank, is it available right away? If you deposit a check, can you take cash out right away?
If you buy deposit a check? No.
The answer is it depends.
Depends on the bank and their policies.
It depends on the bank and their policies. It also depends on where the check is from.
Where it's from.
If I have my business account and my personal accounts in the same bank,
Yes.
and I write a check for my business account and deposit it in my personal account, that money is available to me right away because it's just a transfer within the bank. But if my aunt in Florida sends me a check and I deposit it in my bank, there's going to be a delay before I can get the money out because it has to clear through her bank before my bank will let the money through.
Doesn't it depend on the size of the check too?
It also does. So if it's a really big amount, they're going to make sure that check has come through before they do anything with it. Good question, good point. Okay, we have different types of bank accounts, and we're just going to talk about 3 main types today. There's the checking accounts and savings accounts and certificates of deposit. So, checking accounts. In checking accounts, you can put money in or make a deposit. You can write checks and pay for things. Your bank may pay you interest on the account. Some banks do, some banks don't. Sometimes they require you to keep a minimum balance before they will pay you interest. There may be bank charges, a monthly fee, and those monthly fees will vary based on your bank balance sometimes. If you keep a minimum balance, then sometimes they won't charge a fee. So you need to find those things out. But the other fee that they will charge you is an insufficient fund fee. So if you have $100 in your bank account and you go to the ATM and you take out $50 cash, but you forget that your electricity bill is coming through and it's for $75, then you're going to be overdrawn. And they're going to charge you for that overdraft. Or they might return the check for the electricity bill. Sometimes they'll do that too if you have too many overdrafts. And those insufficient fund fees are very expensive. $30, $35 or more per transaction that comes through. So savings accounts, you can also make deposits in those, and you can make withdrawals. You can take money out of your savings account, but you cannot write checks. So you can't pay bills on your checking or on your savings account. And it will pay you interest. The bank does pay you interest. It's not going to be a very high rate of interest, but it is interest. And there may be a limit on the number of withdrawals that you can make. It's a bit cold out there, isn't it? So you need to check with your bank when you open a savings account how many withdrawals are allowed before you start getting charged. And find out if there's any fee or what kind of interest rate they have and all of that. Then the last type of bank account we're going to talk about is certificates of deposit. And these are a type of savings account, but it's for a term. So you put the money in and you can't take it out until that term is up. So the term could be 3 months, 6 months, 9 months, a year. And then the interest rate is the same through the whole period, whatever that is. So you make a deposit, you put it in for that certain amount of time, and if you take the money out early, there's going to be a penalty. And oftentimes the penalty would be 3 months of interest or more. So you can't, you don't want to take that money out. You don't want to put it in a certificate of deposit if you think you're going to need the money pretty quickly. And now we're talking about certificates of deposit, and they have savings for a set period of time. And if you take the money out early, then there's going to be a penalty. Sometimes it's 3 months of interest or something like that. And the CDs, what will happen when it's time for it to come due, before it comes due, you'll get a letter from the bank. And it'll say, your CD's about ready to come due. And if you want to reinvest it, this is the interest rate it'll be. And it'll reinvest at the same term that you had. So if you had a 3-month CD, when it comes due, it'll automatically reinvest for 3 months. If you don't want to do that, then you take your certificate into the bank and cash it or do whatever you want to do with it. So it may automatically reinvest if you don't go in and take it out. So now let's talk about debit cards and credit cards. They're both plastic. Are they different?
Yes,
Yes.
indeed.
What is the difference?
The debit card is what you got in your account. The credit card is what you want in your account.
That is great. That's a great way
There
to
you go.
say it. Very good. Well, both of them can be used to make payments in the store, by phone, on the internet, anywhere. The debit card will work the same as the credit card. And your debit card, you can either use your PIN or you can have it run through like a credit card and sign for the purchase. The difference is, like you said, the debit card, when you use it, that money comes right out of your bank. So last night we went to Target and I used my debit card. So by the time I got home and I pull up my bank account, it's already showing up there. So it comes out right away. Whereas the credit card, when you do that, then it goes into your credit card statement, your credit card account, and then it doesn't come out of your bank till you pay it. Now the danger with the debit card is if somebody else gets your information, they can take the money out of your account. The danger with the credit card is if you don't pay the bill, you're going to have lots of extra fees and interest, and everything that you bought is going to cost you a lot more because of that extra.
I have a question.
Yes, ma'am.
Now, when you use a debit card as a credit card,
Uh-huh.
does it still come out automatically?
Yep,
The only difference is you're not putting a PIN number?
that's right.
And does it go towards building up your credit?
Well, if you're paying your bills on time and everything, that builds up your credit.
But if you use your debit card as the credit card,
That's not going to affect like a credit card would, no.
so the benefit of using it as a credit card is just not to put the PIN in?
Right. It's a little bit safer. Well, depending on who you talk to. Because if somebody steals your card and they use it as a credit card, then there's no security really. Unless you get a checker that actually looks at the back of the card and compares your signature, which they don't. Very few do.
Can you call your credit card company and say, put this on, flag it if it doesn't show ID?
I don't think they have a way of doing that. Do you know that, Teresa?
I don't think they'd have a way to be able to tell.
I don't think so either. It used to be nothing would go through without your signature. But now that we're so electronic, we've lost some of those
'Cause there's a lot of,
safeguards that we used to have.
there's a lot of places now, even if you use a credit card, if it's under $50 or $100, they don't
You
need
don't
to
have to
sign.
sign. Yeah. Different stores have different limits where you don't have to sign. Some of them it's 25, some of them it's 50, because they figure it's not worth it. So yeah, you do have to be really careful, either whether you use your debit card or your credit card, because either one is dangerous. And it's just a matter of being responsible with what has been entrusted to you. So, ACH transactions, it's short for Automated Clearinghouse. Does anybody know what those are? Does anybody have their payroll check automatically deposited to their bank account?
I used
How
to.
about paying your electricity bill? You pay that electronically, or do you write a check?
I call in
And they take it out?
yes.
That's an ACH transaction.
I have payments set up on auto pay
Uh-huh.
that are done like that.
Yeah. Anything that's electronically, that's an ACH transaction. So if you have somebody, if you go someplace and they'll say, do you want this to be ACH? You know, if you're setting something up with the bank, they may ask you if you want any ACH transactions. That's what they're talking about. Anything that's paid electronically without you writing a check or getting the cash out and taking it in. Okay, now we're going to talk about the nitty-gritty of interest. And there's two different types of interest. There's simple interest and there's compound interest. Simple interest is where you earn the same dollar amount of interest every year. So if you put $100 in a savings account and it earns 3% interest, at the end of the year, they'll put $3 in there, in your account. So at the end of 10 years, it'll be $3 every year, or $130 that you'll have total. So you will earn $30 in interest in 10 years. Compound interest, though, is the interest that goes in then becomes part of the base for computing the next year's interest. So if you put it in a savings account that has compound interest, the first year you'll still get the $3. But the next year the interest is going to be on $103. So you earn an extra 9 cents. And all the way through, so at the end of 10 years, you'll have, instead of having $130, you'll have $134.39. Now the $4.39 doesn't sound like a lot, but over time it really adds up, that compounding. And that's the power of compounding working in your favor. Now the credit card companies know this, and so they use the compounding for their benefit. And the stakes are much higher because the interest rates are higher. Because the credit card companies will charge, the average rate now for credit card companies is over 17%. And some of them charge as high as 24%. I saw one the other day that the interest rate was 24%. And, I mean, that's 2% a month, basically.
So, when you go into your bank to open up an account, can you negotiate a compound interest?
They will give you compound interest. And they will pay it probably every quarter. So if the interest rate, I'm going to pick an easy number that's easy to do in my head. If the interest rate is 4%, then they'll pay you 1% every quarter. So if you put $100 in, then the first quarter you'll get $1. And then the second quarter you'll get a little over $1 because they'll be paying on $101. Does that answer your question?
Yes, but that's in a savings account.
Uh-huh. Or the same works with any interest-bearing account. If you had a money market account or something like that, then it'd be the same if it's any kind of interest-bearing account. They're gonna have compound interest.
Okay. And so where's the simple interest coming at?
Some people, they don't do it so much anymore, but some people used to do that on a transaction between two people. You know, if I gave you $100 because you needed it for something, and I would just say, I'm just gonna charge you simple interest, and so you would pay me $3 every year, you know, rather than it being compounded.
Okay, thank you.
So let's talk about buying on credit, how the credit card companies can use this against you. Let's say you're gonna go get a flat screen TV and it's gonna cost you $600. And you decide you're gonna do it on credit. And so you'll probably have to make 2 years of payments, 24 months. And I looked at the average interest rate right now is 17.12%. So your payment's gonna be just a little bit under $30 a month, $29.70. So how much do you think you're gonna end up paying for that TV by the time you get done? It costs you $600.
According to your records.
Ah, you're looking ahead. Over $700.
Right, and that's what made me go into like rent a center, and I was
Same
like,
thing.
now why am I gonna rent this TV for this much a month? That's gonna cost me double the price.
Exactly.
Get it if I want it. So it's
Right.
better to put it in layaway or wait it out.
That's right. So very good. That's exactly what we're going to talk about. But other times when I've talked about this, people say, well, this store has 90 days same as cash, so I can buy it and I don't have to pay for it for 90 days. Like 8 out of 10 people will not pay that off by the end of the 90 days. And if you don't pay the whole thing off by the end of the 90 days, on the 91st day, they're going to add all that interest to the $600.
So is it the interest, is it what was left that they add the interest to, or the whole?
They will figure it through the whole 90 days. So it's going to be
So
compound
if I make
interest.
$400 payments and 91st day came, I have to pay still the $600 interest?
No,
Or-
it'll be compounded on what your balance was through that 90 days. But there'll be a period where it would be the full $600. And then whatever payments you made, it would be less.
I try to pay mine off when they say, like I went to Nebraska Furniture Mart, got
Mhm.
18 months,
Uh-huh.
no finance. Like 18
Well, if
months.
you can pay it off before the 180th day or 18 months or whatever it is, then you won't have any interest. And that's good if you do that, but a lot of people don't. 8 out of 10 people don't do that.
I do that, and I also make extra payments.
That's
So
good.
if something happens where I can't make the payment, I'm like, well, you know, I'll borrow over a month, and use that payment.
Very good. That's very good. And communicating with them about that, that's good to do too, because that keeps them on the same page as you, so that they don't charge you extra fees. So let's go through this. If you don't pay, like I said, if you don't pay the entire balance, all that accumulated interest gets added to you. So let's look at this. If you paid nothing on the TV during the 90 days, then $26.05 of interest would be added to what you owed. So it'd be like as though you paid $626 for that TV instead of $600. Then if you started making the payments and you went ahead and made the 24 payments, is your balance going to be zero? How much will be left? Don't look.
I'm not looking, I said make the payments for 24 months.
And you had $26 of interest already.
So it's gonna be 26 every month. 20, their
Well,
interest, the interest.
There'll be, now it's going to be $36 that you're still going to owe. Because that 26 made that much more extra interest. So by not paying that off in the 90 days, it costs you a lot more money. So that's the power of compounding that's working against you. Then there's another danger of buying on credit is the late payment fees. You're doing the right thing, you're paying extra.
I pay
And-
extra, but I've also gotten my brain freeze, so I had to call up there. They do let you do the one time a year. Well, I've been lucky to have at least a one time a year will waive your fee.
Oh, that's nice. A lot of places don't do that.
I call up.
Because, you know, if you, say your aunt died out of state and you totally forgot about making that payment, and you go, and then you realize you didn't make the payment, they're gonna charge you a late payment fee, and it's probably gonna be $30, $35. And they're gonna add that to what you owe, and you'll start paying interest on that. So you're gonna have more interest.
The Furniture Mart, I will say, is very good about this because I made a payment once and there was a blizzard that day and I couldn't get over there to make it and I called and she said, you know what, we have a 10-day grace period. Anyway, I'll note on your account that you wanted to come. She said, don't come out. It's too terrible. And they let me come in the next day and pay.
And that's like what I told her, you were communicating with them. And you communicate with them and it makes a big difference. And a lot of places do have that 10-day grace period where they will give you that time. But if you're habitually late, then you're probably not going to get that much. They're not going to be as kind to you. So the other thing, and you kind of talked that you might be doing this, that use the power for you. So instead of paying that to the credit card company, I did the math here, and if you saved $25 a month and you got 3% interest, and you saved for the same 24 months, how much do you think you would have?
You said 25.
You'd have over $600. You'd actually, $25 times 24 months is $600. So even if you didn't get any interest, you would have the money by planning ahead that that's what you were going to do. So, who gets the power? If you do the credit card company, you can pay almost $30 a month for 24 months. You're going to pay over $700 for that TV, and the credit card company is going to get that extra $113. Or you can save $25 a month for 24 months. Your total payments are $600, and you have $17.57 left after you pay for the TV. So by saving instead of using credit, you paid $112.80 less for that TV, and you had $17 left over. So any questions?
This time, the best thing to do is try to pay your credit card off in the 30 days that they tell you, so you don't incur any interest.
Right.
If you have to, you're gonna hurry up, pay it off as soon as possible.
And save before you buy. Make sure you have the money before you pay for it. It's the best way, because then you're using that power for you instead of the credit card using it against you. And all that's left is my contact information, but you have that in the folder. My card should be on there in your folder. And next week we'll talk about your spending plan, and that's just spending or planning ahead how you're going to spend your money.